Could traders and investors be losing faith in the debt markets as both Japanese yen, German and the US yields all spike into this inflation data coming in less than 24 hours? What exactly is going on? In today's video, we unveil what the game plan is and of course what we're heading into. Big earnings season and the banks are about to report. With the trend line that everybody's watching, big gamma on the way and of course options flows everywhere. One thing's for sure, there's a lot of huge moves on the horizon. Guys, join us as we cover stocks, commodities and cryptos on one of the biggest days of the year. See you soon. Well, welcome back everybody to the Daily Show. My name's Tom and in today's video we have a lot to discuss. What's going on in the debt markets and yield, what of course is happening ahead of earnings season, and is leverage too high right now? Well, it looks like the bonds market is starting to flash up again, and this time we're seeing it in one of our favorite indicators coming up later on today's show. But let's kick things off here with Japan's long bonds. They are re-accelerating, and you've probably heard this by now that both the 20, the 30 and the 40-year yields are all on the rise. And this is not just happening in Japan, we're also seeing it in Germany. The 30-year at a 14-year high. The 30-year in the US at 5%. We know that something has always happened at around this level. So what gives? Well, it's a mixture of either reinflation coming with, of course, inflation reports coming out in less than 24 hours, or it could be that people are starting to think about sovereign debt as a little bit risky. Effectively, there is a certain need to say, you know what? I'm not going to give you any money unless you give me a lot more in terms of interest. I think you're riskier than you were years ago. And this is starting to cause a bit of a loss of faith in the long-term fiscal discipline of the banks and more importantly, central banks around the world, and whether we're actually going to see a bit of a crisis. And I think it's one of the most important things that you want to be watching over the next 6 and 12 months in particular, because as we know, we've got huge amounts of treasuries which need to be refinanced by the end of this year. If it's your first time here to the channel, make sure to subscribe and hit the bell for that icon as well, because this is going to be a big story and I don't think anyone's really quite aware of how much debt really needs to be financed later on. I know you guys are, but maybe not some of the newer viewers. Let's now talk about what's happening here when it comes to June CPI. You guys know that all of these economists have different ideas. In general, they believe it's going to be 0.27 and that they think the headline is going to be 2.6%. Now, previous month didn't show that. And one of the eagle-eyed viewers out there actually posted this, which is true inflation versus BLS. And it's basically suggesting that we could be at that kind of point where maybe we should be actually seeing a weaker number, that is inflation actually dropping. And if we don't see that, he's of the opinion that maybe it's not real, because of course we have the lead indicators telling us that maybe there is actually deflation occurring, and the lagged indicator, which is often the one that we see the Fed use, as showing, possibly just kind of stagnation of these numbers. So this will be an interesting one, not to be proven yet, but of course the CPI will matter. And it's going to be one of those volatile events along with JP Morgan's big result, because of course the banks are kicking off. Usually people look at Goldman Sachs, JP Morgan the most, see what's going on. And while I would think that they're probably still going to be making a little bit of money for sure, the one thing is that the stock market has started to sell them off into this level. So we're now at the daily 20 moving average for JP Morgan. As you guys know, that is a massive support level, and it's been a very important level since we've been rallying this entire time. Where the financials generally go, the rest of the market will at least eventually follow. Let's now talk about where the flows are though. My goodness, look at this one. Flows moving into crypto. We suspected this was happening for weeks and weeks and weeks and even months. We've seen actually a lot of ETF net flow into Ethereum and Bitcoin. According to the latest Glassnode data, which we have over on our X account, links in the description down below, we're seeing a massive acceleration. This is actually the largest ever institutional demand here in terms of acceleration for Ethereum, and that helped to break the market out to new highs. And that's thanks to deregulation and of course the idea of what we've been seeing recently, which is these tokenization kind of things going on. Hyperscalers are also spending pretty big. According to the latest Goldman Sachs data, it looks like all of the big tech companies and even the smaller tech companies are going ballistic on capex spend. Now, we did talk about how a lot of businesses are pulling back. That's the older stocks. Things like, in the S&P 500, the older industries are spending less in the world of tariffs. But it looks like all of these big guys, and that of course is pretty much 37% of the S&P anyway, as 10 stocks make 37% of the S&P right now. We're basically at this point where they're spending big time on improvements in the AI world. Now, this is going to be the big growth engine for the US. Innovation is why we all love the US market, and it's been the big thing. Remember, 83% of the time, tech leads. So at the moment, we've seen semiconductors pick up, we've seen AI stocks go ballistic and hypergrowth go ballistic. So that has been really where the strength is. And you've got to always look at the US market as tech, and everything afterwards. Now, what else have we had really break out this year? Well, of course, it's been precious metals. You guys know gold, silver, platinum. I've been bullish it all, and so have a lot of you guys. And it's been, an excellent trade. I think actually platinum is the best precious metal for the year, up well over 40% since December. However, could we be starting to see other metals coming along, aluminum or aluminium as I call it, or iron ore or any of these others? Well, according to the latest data here, you can see the ratio from Octavio. Basically, this is a pretty cool read because it takes into account where gold is right now, and it says, you know what, all these other metals are too cheap. And you guys know I love ratio trades because this is how the biggest guys do it. The big investment bankers, the big hedge funds, they look at things as comparative value. And that's a really extraordinary way of doing things. When I first got into the industry a long, long time ago, and I was taught about ratioing, I was basically told this is the way that, all the big guys do it because, of course, we're looking for comparative value. And yeah, we're down at those points once again where it looks like we may be seeing a possible boost up here in metals across the board. And this actually does bring in why it's so important over the next 24 hours to see how this inflation data reads. Guys might remember the 1970s versus the current day. Are we going to get an update that actually shows that actually going up again? If that is, then we could be going to stagflation. Such an important time for investing. Speaking of which, it looks like everyone is of course going ballistic. We're seeing a huge amount of leverage in the system. We've got all-time highs in terms of FINRA margin, we've got all-time highs in terms of single stock leverage ETFs, and of course we've got all-time highs in terms of markets themselves. So is that a concoction for Wall Street to eventually steal from us, the retail traders and investors? Well, you guys know it is. Of course, we all know it is. It's going to happen one day. They'll run pull us. But if we actually look at the closest narrative, and you guys know we've been talking about this, the S&P 500 1998 versus the current 2025 market, we could be in a period here of what we call a pit, a pullback in time, or a bit of a sell-off coming into Q3. And there are a couple of reasons. One, we've never seen anything about whether tariffs are actually hitting the economy or not. So that's, of course, generally lagged around 3 to 4 months, and it's been that time now. We also are due for a bit of a pullback due to the fact that everyone has been going ballistic, and of course stocks have been going up 60 to 80% since their April lows. So we've had that epic B-shaped style rally. But imagine if this is how it continues on. Geez, there's going to be a lot of kangarooing in the markets. We're going to go ups and downs and ups and downs. And this may not look like much, but a lot of these sell-offs are in the vicinity of 12, 10 to even 15%, which may not sound like much, but these are actually quite large sell-offs if you've been trading the market for a long time. So that's going to be interesting. We also know that we're at that point, the middle of July. And I want to say congrats to all you guys that did buy that pit late in June and basically said, you know what, pull back in time. Statistics are that Christmas in July is one of the best reads of the year, the best 2-week period of the year, and it rallies usually into the middle of the month. Now, this is where we notoriously get the kangaroo style market, but I tell you what a rally. Remember to keep that in the back of your mind. And as you guys know, it is pretty normal to be doing this year. Year threes, after 20% years back to back, they're choppy. They're up, they're down, they're up, they're down, they're very volatile, and they're all over the place. And of course, this year seems to be following a very similar track record. In terms of forward PE ratio, we're expensive. Look at this chart here. It's not good. So we're not the most expensive we've been, but we're certainly getting up there. And the last time we saw this kind of expense was obviously when we were over here back in the October period of last year. So the markets are kind of, not cheap anymore. When they get back down to these ratios, you can kind of say, okay, it looks all right. But EPS has been on the rise, which is good. And that's telling you that, of course, okay, this earnings season may be actually all right, and possibly speaking here, we might actually be in a climate where markets could go up. In fact, this reads here, the S&P 500 technology sector is up 9.5% over the past year. Not too bad. But it's actually gotten 6.5% cheaper